China, the world's second largest economy, and with a population of over 1 billion people, has fallen on hard times in the past few years. From COVID shutdowns to deflation to China's mounting debt adding up, youth unemployment is on the rise, a real estate crisis, and China's shadow banking troubles. Will this economy that once prospered finally fall? Now, China's trajectory tells an interesting story. The economy expanded an average of 9% per year from 2000 to 2019. However, since the COVID shutdown, there have been many major issues plaguing China's economy. We'll start with the first one. Shadow banking. Shadow banking is a sector of China's economy that provides money into a wide range of investments across different sectors of the economy. These investments are separate from bank-based lending. The official interest rate on bank deposits in China is 1.5%. These large trust companies have been offering China's investors much higher rates of return on their savings than bank deposits. These trust companies suggested that investors would be protected from potential loss of capital. China's economy was growing at double-digit returns from 2000 to 2019, and these higher rates of returns were much easier to achieve during those years. But in recent years, the tides have turned, and these returns have become much more difficult to achieve. Goldman Sachs estimated that losses across the Chinese trust sector could reach $38 billion. There have been many investment products that have been identified that have missed payments to beneficiaries who were so used to regular monthly payments at that point. Now, the trust companies have also been reported to have halted redemptions on shorter-term investments, making it very difficult and sometimes not possible for investors to withdraw their funds. Now, one of the trust companies, Zongrong, placed a major bet on the real estate industry by investing in troubled housing products. These housing products, unfortunately, have not rebounded yet. Another huge problem in China is youth unemployment. China's unemployment rate for young people between the ages of 16 and 24 was a whopping 21% in June. In July, economists expect that the youth unemployment rate increased. However, after June, China stopped reporting figures on youth unemployment. The youth unemployment rate has doubled since the COVID pandemic, started where companies were weary of hiring people. There was a lot of interrupted education, and internships were really hard to come by because of the strict precautions of the COVID-0 policy. On top of the damage inflicted on the job market during the pandemic, the Chinese government cracked down on the country's technology, real estate, and education industries, where the educated young Chinese had flocked for jobs. The regulatory actions caused hundreds of thousands of layoffs and left companies and investors more cautious about expanding their businesses. When businesses are weary, hiring typically suffers. Young people in China, they're facing a big gap between labor demand and supply. According to official data, 11.6 million students were expected to graduate college this year, the most ever and nearly 1 million more than last year. Future classes are expected to be even larger, while economic growth has started to slow even before the pandemic. Industries like construction and transportation, which usually draw more interest from migrant workers without degrees, have picked up. But sectors like technology and education have been much slower to bounce back. Interesting fact is that even becoming an entry-level civil servant working for the government is much harder in China these days. Last year, a record 2.6 million people applied to take the national service exam to compete for only 37,100 entry-level positions. In recent years, China has been experiencing enormous real estate problems. China used to rely on a very strong real estate sector for its economy, but in more recent years, it's fallen on much harder times. The country's population isn't growing the way it used to, and years of strict COVID-19 restrictions have been shaking Chinese consumers to the core. The government has also cracked down on risky practices in the industry, a combination that has left real estate developers with enormous debt and more new housing units than buyers. Home prices have slumped, denting Chinese households' savings and confidence as the government tries to transition from an economy that was once powered by state-directed investments and exports to an economy that's being led by domestic consumer spending. By one estimate from Gavakal Research, unpaid bills from private Chinese developers totaled $390 billion, a major threat looming over the economy. Country Garden, which is China's largest real estate developer, said this month that it expected to report a loss of up to $7.6 billion for the first 6 months of the year. The company's share price has tanked as investors feel it could default in billions of dollars in loans. China Evergrande, which is basically another major real estate developer in China, recently filed for U.S. bankruptcy as it restructures its debt. The company had defaulted on $300 billion of debt in 2021. And back then, that was one of the first major signs that China's real estate industry was in deep trouble. China's economy is experiencing deflation as consumer prices have declined in July for the first time. So, what is deflation? Deflation is a decrease in the general price level of goods and services when the inflation rate goes below zero. Currently, China has an inflation rate of negative 0.30%. Recently, there was weak import and export data from China, where exports dropped about 14%, while imports dropped 12.4%. Declining prices make it much harder for China to lower its overall national debt, which will result in a slower rate of growth for the country. Now, China has national debt of about $13 trillion to try and tackle, so the last thing they really need is declining prices. As an example, if cut-price Chinese goods flood global markets, it could have a very negative impact on manufacturers in other countries. Another major problem with deflation in China comes down to the fact that China just produces the vast majority of the world's goods, such as clothing, food, and raw materials that we use every single day. As a byproduct, declining prices in China would ultimately hurt company profits and spending in China, which inadvertently, could lead to higher unemployment outside of just the youth unemployment of, 21%, which was, back in June. As a further result of deflation, this could also result in a decrease in demand for energy, food, and other raw materials that are made in China. Really, the only positive note to deflation in China is that, it helps to curb rising prices in other parts of the world, including the UK and the US, who have obviously seen prices of goods and services rise tremendously in the past few years, as those nations have, dealt with rising inflation. Now, even with all the issues that China's economy is facing, it's really important to note that the economy is not necessarily crashing at the moment. Economists are still expecting China's gross domestic product to grow 5.1% this year in 2023, 4.5% next year in 2024, and then 4.6% in 2025. China's going to obviously have to tackle these problems, especially the national debt, especially youth unemployment, deflation, all the problems that we just went over. China is also starting to see what they can do to increase consumer consumption in the economy. They're also encouraging graduates to go out into the country to do manual work. They're trying to crack down on shadow banking, but also on the flip side, they don't seem to have much of an answer to improve the real estate sector or deflation. Well, if you've enjoyed this video, feel free to give it a like. Feel free to comment down below your thoughts on China's economy, and feel free to subscribe for more finance-related content. Until next time, take care.